Thanks very much. It's good to be here in Philadelphia. I've actually done a lot of deals in Philadelphia over time. Most notably, I advised Comcast when they did the AT&T broadband deal about 13 years ago, which really transformed Comcast. And I also advised Conrail when they were going through their battles, first trying to merge with CSX and then ending up getting split up between Norfolk Southern and CSX. So I have spent a lot of time in Philadelphia and love it. The M&A market, even before we go into the slides, it obviously has been a big part of investing, and I know that these guys try to figure out acquisition targets, and it's a big part of what they do. The M&A market really has been pretty extraordinary the last year and a half. But a lot of the reasons that people thought that M&A would be a very focused part of the market have actually existed for a number of years. For example, low interest rates have really been around for 3 or 4 years. The availability of leverage has been around for 3 or 4 years, and low growth has been around for 3 or 4 years, where it's really, really hard to get growth in your organic business. And so what's changed, which I'll get into, what's changed is that there's less volatility in the stock market. If you look back 2 years ago, even at the end of 14, at the end of 13, there were wild swings in the stock market, 500-point swings, 750-point swings, and people just couldn't transact business in that kind of environment. Now you see a pretty steady, not volatile market. The VIX is down, and so I think that's more why people are transacting business. So if you kind of take a look at the overall M&A market, it was up dramatically in 2014, and it's up again in 2015. What's interesting about what's driving these deals is that it's larger deals. If you look at the lower left, you'll see that the actual number of deals today is down, but the size of deals is up considerably. If you look at the number of 5 billion plus deals that have happened so far this year, it's up over 50%. In the middle of that, though, I do want to make an observation, because we were talking about the Comcast deal. A big area of concern, I think, for M&A people is the regulatory environment, which is holding things back. And I think there were 2 deals that were blocked in the last week from a regulatory perspective. One was Comcast buying Time Warner Cable, which was really much more political than it was a real legal issue. I remember back in the 90s, I was advising MCI when they were trying to merge with Sprint. And the government blocked it on the basis that these 2 parties dominated the retail consumer long distance market. And we tried to explain to them that there was no such thing as a retail consumer long distance market. It just didn't exist. I mean, cell phones existed then. All the local phone companies doing it. Looking back, it's kind of a joke that they blocked that deal. And looking back on Time Warner Comcast, it really is kind of a joke where everything is going now. These companies don't dominate anything in the world of over the top, in the world of distribution through Amazon, Netflix, and that kind of thing. It really is, it didn't make any sense from a legal perspective, but the political environment is very, very tough in Washington now, and there are a bunch of deals that should happen that are not happening because of the political environment. And it's actually even worse than that, because in the past, there was something of a rational basis to the politics. And again, just to put it out there, even though I'm in the Union League Club, I've always been hopelessly liberal, except more recently. But to kind of put it out there, it's real politics now. So we mentioned before the United Airlines Continental deal. I advised Continental in merging with United Airlines. And it was really Continental was taking over United Airlines, clear takeover. But they decided, for political reasons, that they would move the headquarters to Chicago, home of our president and his chief of staff, Rahm Emanuel, and they'd rename it United Airlines. So they did that. I was there at the signing ceremony. They called up Rahm Emanuel, and everything was great. No regulatory challenge. That deal should never have gone through, by the way. So the net result is that when the government tried to block American Airlines merging with U.S. Air, they had no basis to stand on. So the frustrating thing about it is usually there's some kind of rational basis, and now it's politics. It's very hard to transact in that environment. Another deal that was blocked last week was Tokyo Electron. And Tokyo Electron was our client out of Japan that was merging with Applied Materials. And they were doing it in a very creative way by setting up a new company in the Netherlands. And that's relevant for a couple of reasons for you guys, because it really shows that it is a global investment market now. That deal got blocked by the regulators, really no basis for it. These are not the biggest players. What was unique about that deal is that there used to be this concept that everyone believed you couldn't, for example, issue US shares into Europe without them flowing back and really harming the trading value. I advised Verizon when they bought out Vodafone's interest in Verizon Wireless. We issued $60 billion worth of shares into Europe. There was no effect at all. And in Tokyo Electron, Applied Materials, here they're forming a Japanese company and a US company, forming a Netherlands company, and the one issue trading was just fine. It really, really is a global market now, which is quite relevant when you have global investment strategies. So high point is M&A is up, but it's mostly driven by larger deals. If you look at the regions, the US continues to be the strongest market by far, although it appears that Asia was actually up. That was driven by some restructuring deals that really weren't M&A deals. They just happened to be in the league tables this year. Asia actually has been very weak now. We've been waiting forever for there to be more deal activity into Europe. And you would just think of the way that the dollar's strength, if people really thought that anything in Europe was calming down, it still hasn't happened. And I think that obviously the European markets have done better this year, but the big flow of M&A really has not happened as much as people thought. And cross-border is kind of consistent with historical levels, which is about $1 trillion worth of deals. I think we will see more cross-border deals happening because you can use stock. And by the way, the great thing about M&A, because I've been doing this for 36 years, is that it's always a great time for M&A no matter what. So if the stock market is up, it's fantastic because you can use your stock as currency. If the stock market's down, it's great, you can get great values. I've never seen it when it's not a great time for M&A except when it isn't. Because it basically is a cyclical market. I should have pointed out when I was doing the slide on the growth of the M&A markets, is that there's an extraordinary correlation between overall market cap and M&A volumes. If you look over 5, 10, 15, 20 years, M&A volumes seem to equal about 4 to 5% of global market cap. It's pretty extraordinary, the correlation. Sanford Burgess put this report out a few years ago, which was quite fascinating. Financial sponsors, a couple of interesting things about this. What's really driving the financial sponsors now is they are out there selling everything they can sell. And a lot of their sales are to other financial sponsors, which is a great business to be in. You probably saw in the Sunday Times kind of the record of not only hedge funds, but private equity firms over the last 10 years and how they haven't really beat the market. But what is curious now is that all these financial sponsors see that this is the best time they could possibly find to sell assets. The banks are back leveraging at 6 times or plus. Interest rates obviously are very low, amortization is low, and so they are selling everything they can find. They're not that much on the buy side other than other private equity deals, but there's not a lot of that going on. And if you look notably in the lower right-hand side, the number of public to private deals that have happened is dramatically off. And that's basically public companies deciding to go private. That's just not happening anymore. Notable big deals that did happen were deals like Dell that happened last year. That really drove the market. I actually think that if you look at this historical perspective, People have criticized going private deals as being conflicted deals. I always tell boards that you really have to look at it. There's a public market for things that you can see every day, and there's a private market for things. And you, as a board, have to see where you can get more value. So back in 2007, when the banks were leveraging at 10 or 11 times with no covenants, if you were a director of a public company, you really should have thought about taking a company private. And companies who did it back then, there should be parades for those directors. And of course, a lot of money was lost by bondholders and the like. Rolling the clock forward, though, what gives going private transactions a bad name are deals like Dell. I mean, Dell was an absolutely abysmal deal for shareholders. They basically took the company's own money, put almost no new money into it, and just bought themselves out. And it was on the theory that you can do things as a private company that you can't do as a public company, which is nonsense. You can do anything as a public company you can do as a private company. Gerstner transformed IBM as a public company. And but anyway, you're going to see that deal and will end up being a home run for Dell and for Silver Lake. So now you're sitting in the boardroom, and this really is what's driving M&A. Revenue growth is absolutely slowing, and it's very, very hard to get organic growth in your business. It's hard to raise prices, it's hard to get organic growth. EBITDA margins are flattening out. This has been driven a lot by cost cutting, and earnings, growth is stalling. On the other side of it, you've been getting these very large returns, and PE multiples are very, very high right now. So boards now really are focused in management on M&A because they really believe that is the only way that they can drive growth. Now, I'll go on in another couple of slides, but I also think that means that a lot of really stupid deals are going to be done. Because people, in my mind, when you do an M&A deal, and when these guys do the analytics on M&A deals, it all comes down to intrinsic value. And for the buyer, nothing else matters. And everything's accretive now. How could it not be accretive when things are trading at such high multiples and when interest rates are so low? So I think looking back, there'll be a lot of bad deals that get done. Another factor to be looking at in the market now is that the stock buyback play is basically over. I've never believed that stock buybacks can really drive value. In fact, it seems to me to be impossible that you can make a company more or less valuable by buying back stock. Now, that doesn't mean that there isn't the right capital structure. So if every company has this optimal capital structure so it can grow, and so it can invest, and it has firepower for M&A. And if that capital structure leads you to believe you have excess capital, fine, buybacks are fine, nothing wrong with it. There's no difference between doing an extraordinary dividend and a buyback. Really, how can there be any difference? But for years and years, the market has loved buybacks. And what really broke the back of this was IBM a year ago, where they announced really bad earnings, and they announced a $20 billion buyback. And the market was, you've got to be kidding. That the solution to your business is more financial engineering. So I think that is finally, as it should be, being laid to rest again, it's perfectly appropriate to do with excess capital, but it's not a real driver of value. What is real in the market is increasing dividends, because it does, in a low yield or zero yield environment, it does give people kind of a floor price for the stock. And I think that you're going to see more and more people going towards the dividend path and really trying to find acquisitions rather than doing buybacks. I'm not the expert on this, but obviously multiples appear to be pretty high. The only, and particularly in the top quartile. If you look at the top quartile of multiples in the S&P, 30 times is pretty high up there. By historical standards, the average is not that much higher. But what this naturally leads people to do is to use their stock more for acquisitions, which makes perfect sense to do. So this is what I was referring to before, is that it seems no matter what anyone buys for any company, their stock goes up. It matters not what premium you pay. We advised AbbVie in buying Pharmaceutics or whatever that company, you would know that company, for some infinite amount of revenues, stock went up. And there's almost no deal you do in this market now that you announce where the stock doesn't go up. And I just think that's a huge danger signal as an investor. You really have to be laser focused on whether the real returns are there. And the way I look at it is that companies can't, at least in year 2 or 3, earn more than their cost of capital, bad deal. It's just a bad deal. And I guarantee you, we're seeing a lot of very bad deals. So where does that leave us? Talk about a couple of things. One is activism. And I've said for many years, obviously we had to deal with an activist, the lovely Keith Meister, Corvex. There were some others in the stock there. There are very good aspects of activism. It really is forcing people to focus on core business and to do smarter acquisitions. It's also the era where people are creating conglomerates is really over. I mean, the idea that Fortune Brands was ever formed, where you had Titleist golf balls and Jim Beam liquor, or Sara Lee, where you had sausage and Hanes hosiery, and these companies made absolutely no sense. Those conglomerates, ITT, Gulf and Western, all of them have been dismantled, and of course GE is in the process of being dismantled. I think that is a direct result of activism and people being forced to focus on their core business. So I think that's a good thing. It's affirmatively a good thing. The bad thing about activism is when they force companies to return capital and put themselves in a weakened state, which is very short-sighted. Now, I just finished advising the GM board, and it was a challenge. And we went in front of the GM board. Imagine this company that's been in bankruptcy, and an activist shows up and says, you have to go return $20 billion worth of capital. And I basically said to the board, I said, look, this is pretty straightforward. You shouldn't do anything because you have an activist in your stock. You have to figure out the right balance sheet for this company for the long term. And if you end up losing a board seat or two, who cares, right? That's a lot better than blowing up your company. And they took the advice. Now, we ended up not having to put anyone on the board, but we also ended up doing a structure where we kept $25 billion cash cushion. So we didn't do anything irrational. But you cannot imagine the number of companies faced with activists who panic and really trash their balance sheets. Very negative thing to do. This is a very good time for deals to get done. There is no growth in the market. I think going down the page, we've seen a reasonable number of hostile deals. Those are very hard to do in the U.S. They're a little bit easier to do overseas because you can't really put up any frustrating actions overseas. In the U.S., hard to do. I spent a good deal of last year advising Valiant on its hostile bid for Allergan and ended up getting outbid. Right now there's a 3-ring circus going on between Teva and Mylan and Perrigo, which we were involved. We're advising Perrigo. I have no idea how it's going to play out. These are tough things. These are very tough to invest in. It's entirely different. I know that these guys target sectors and have been very good at identifying companies that get bought, like Informatica and others, but it's very hard to play the ARB game now. There are too many moving parts. The regulatory is very complex, and so people are actually the ARB play in these are getting lower and lower. And as I said before, I think the regulatory environment is pretty challenging. But as I also said, it's always a good time for M&A.